Good evening to all of you. आज नवरात्रि का दूसरा दिवस है। आप सबको नवरात्रि की हार्दिक शुभकामनाएं और माँ अम्बे की कृपा आप सब पर ऐसी बनी रही, ये मेरा एक विचार है। On behalf of National Exchanges Members of India, I, Hemant Kakkad, Chairman ANMI Northern Region, welcome you to a program organized by ANMI NR with prestigious CMT Association on navigating the markets with technical analysis. It is a privilege for me to stand before you today in this journey of exploration and enlightenment. Today's event marks a significant collaboration between the Association of National Exchanges Members of India and prestigious CMT Association. It is a testament to our collective commitment to provide you with the knowledge and tools to navigate the markets through the lens of technical analysis. I would like to thank each one of you for taking time out of your busy schedules to attend today's program. I welcome you all. I welcome all senior members, past and present office bearers of ANMI NR and members of CMT Association to the program. I thank you all from bottom of my heart for attending today's event. Your presence is a big encouragement for all of us. We have gathered here not only to enrich our understanding on technical analysis, but to interact with like-minded individuals who share a passion for financial markets. Whether you are an experienced trader, a seasoned investor, or someone who has just started your financial journey, this seminar promises to offer insight, knowledge, and a forum for meaningful interaction. The agenda of today's program includes 2 sessions that span the spectrum of technical analysis, covering everything from trend following strategies to market behavior. These sessions are designed to empower you with the tools and knowledge necessary to make well-informed decisions in the world of finance. Before we delve into our sessions, we have a special moment planned for you. We will have a traditional lamp lighting ceremony. Following this, we will honor our distinguished guests with token of our gratitude for their presence, their contribution to the field of finance. As we prepare for the lamp lighting ceremony, an auspicious tradition that symbolizes the triumph of lights over darkness and celebration of knowledge and wisdom. It is my honor to extend a warm invitation to our distinguished guests to join us for lamp lighting. And before the lamp lighting, I would request our distinguished guests to join me on the dais. We are fortunate to have ANMI President Mr. Vijay Mehta with us today. I would request him to kindly join me on the dais to welcome our distinguished guests. Vijay ji, please come. I would request our key speaker of today's program, Mr. Tyler Wood, Managing Director, CMT Association, to join us on the dais, please. So, a big round of applause for Mr. Tyler. Now, I would request our second speaker of today's program, Mr. Joel Pannikot, Head Asia Pacific CMT Association. Welcome, Joel. A big round of applause for Joel. As we prepare for lamp lighting ceremony, an auspicious tradition that symbolizes the triumph of light over darkness and celebration of knowledge and wisdom, it's my honor to extend a warm invitation to our distinguished guests to join us for the lamp lighting, please. Please come. Now I would request ANMI Director Mr. J.P. Agarwal and Mr. Ashwini Goel to kindly come and felicitate Joel, please. IGP. Now time to thank Mr. Kaiser Marolya, the Head Partnership and Growth CMT Association, who has been instrumental in organizing this event. So I would request ANMI NR Vice Chairman Mr. Rajkat Gupta to kindly come and felicitate Kaiser. Please, Kaiser bhai. As a token of our deep respect and appreciation for our distinguished guests, we have chosen a symbol of timeless wisdom and spirituality, the Bhagavad Gita. We believe that the values and wisdom in the Bhagavad Gita align perfectly with the qualities we honor in our esteemed guests today. So we wish to felicitate them with this timeless scripture as a gesture of our profound respect and admiration. Now I request Mr. Ashish Saraf, past executive member of ANMI NR, who has been closely associated with ISKCON Society for last 20 years. He has acquired the degree of Bhakti Shastri and teach Bhagavad Gita to others. I would request Ashish to join me on the dais and present our guest the holy book. Ladies and gentlemen, a big round of applause on felicitation of our distinguished guest with the presentation of the Bhagavad Gita. Thank you, Ashish. Thank you. Now I request ANMI National President Mr. Vijay Mehta to address the gathering.
On behalf of ANMI, I have great pleasure in extending a formal welcome to Mr. Tyler Wood and Mr. Pannikot for having been able to spare time to come here and address the esteemed gathering of members from ANMI NR in the presence of our worthy ANMI NR Chairman, Mr. Hemant Thakkar. In fact, you might be surprised to note that this is the 5th program in the last 6 days what ANMI NR is organizing. So, on 12th October, there was a program in Surat. Janam is here. Janam, please stand up since you have come all the way from Surat, which was organized by ANMI NR and ANMI WR on long-term investment with Samir Arora. This was a program which was probably attended by about, I am told, by about 1,000 people in a very big auditorium in collaboration with Southern India Chamber of Commerce. On 13th October, me and Hemant were together in Mumbai to meet different SEBI officials. And I was there also to participate into the ceremony by MCX when they are starting their new index. Today I was a keynote speaker there. On Saturday, 14th October, a very big program was organized by ANMI called Investitia in Bombay in BSC International Convention Center, where about children from about 35 colleges of Bombay, about 600 children came over, and we told them about the different areas of making investments and how to be cautious about making investment. Hemant there again took the cake with organizing the program with Mr. Vijay Kedia, who is one of our ace investors and who taught the mantras of good investing by singing. He has a number of good CDs cut out by him, where he teaches everyone in his melodious voice how to make money in the stock markets. Yesterday, there was a half marathon organized by our regulator SEBI in New Delhi, which was again organized in collaboration with ANMI NR, and today evening we are having this program on 16th October with CMT Association. Keeping in line, again we are organizing by about 4 programs in the next about 5 days or 6 days. So I think it has been excellent, keeping us quite busy, and we have been organizing excellent programs. This program in particular is of great interest to all the people who have come to here, and these are all, Mr. Wood, I must tell you that these are all the hands down traders and brokers. There is no absolutely, they were all so keen to know how you are making money and how you teach making money. So they are all here to listen to you. I am sure that we will be greatly benefited with the experience and wisdom of Mr. Wood and Mr. Pannikot, who will tell us the secrets. And I have requested him to also tell us about his famous, he is a co-founder of GoNoGo charts. So we all know that nowadays markets are dominated more by technicals and less by fundamentals. 90% of our trade is done in F&O or options. So where the technicals play a very big role. I am sure that your worthy advice will benefit all our members. Thank you so much once again, and we look forward to listening to you. Thank you very much.
Thank you, Vijayji, for the best wishes and the encouraging words. Before I call upon our key speaker, Mr. Tyler Wood, to give his presentation, I would like to read out brief profile of Mr. Tyler. Mr. Tyler Wood, CMT, serves as Managing Director of CMT Association and the co-founder of GoNoGo charts, a data visualization tool that simplifies market analysis to remove emotional bias from investment decisions. Tyler leads a global non-profit with the aim of elevating investors' mastery and skill in mitigating market risk and maximizing return in capital markets through professional ethics and continuous education. Taylor is familiar voice to many as the co-host of Fill the Gap, the official podcast of the CMT Association, and a regular guest in university classrooms through the academic partner program. He is a seasoned business executive focused on educational technology for the financial service industry Since 2011, Teller has presented the tools of technical analysis around the world to investment firms, regulators, exchanges, brokers and dealers. As we embark on this journey, I encourage you to keep an open mind and actively engage with our speakers. Remember that your active participation and engagement will make this event all the more enriching experience. Also feel free to ask questions about the topics covered in the presentation of our speakers. Now I request Teller to kindly come and present his presentation. Thank you. A big round of applause for Mr. Teller.
I should grab the advancer, right? Thank you so much, Hemanti. This is it's such an honor to be here with you all. Speaking of auspicious occasions, 15 years ago, well, next month, 15 years ago, I came to New Delhi for my wedding. I think my first trip to Delhi was in 2001, and this is probably number 30 or more stamped in my passport that comes from India. And I've been very bullish on India since I met a beautiful Bengali girl in undergrad and fell in love with the flavors and the music and the people of India. As diverse and many as you are, it's a real pleasure to be here with you tonight. And with that introduction, I have no way of living up to your expectations, so I should probably just say goodnight now and head back. But I have to deliver a sincere thanks to Hemanti for putting this together. And I work with partners all over the world, and you often find people who are either very enthusiastic, they talk a big game, or they're too busy to really work with anybody. Hemant was enthusiastic and followed through. He has a passion for bringing the community together, for having ANMI. We just heard 5 events in 6 days. That's incredible. It's an incredible effort, and I think we should all give him a very large round of applause. I had no idea what to expect, but walking into this room, clearly, ANMI is a formidable organization, and we are extremely honored to be partnered with you. So on to the subject matter, right? The end of analysis paralysis. And hopefully what I'm going to talk about with you all today is something that is universally applicable. I'm not going to teach you how to trade the way I trade because it's a deeply personal matter. But hopefully everything that's in this deck, all 700 charts that I brought with me, are going to elicit some educational ideas that you can put to work in your own practice. So 3 simple goals. I'm a very simply minded man. I can't remember more than 3 things on the grocery list when my wife sends me out to the store, so I only have 3 things to talk about. The first are the tenets of trend following. So we got to talk a little bit about what we mean by identifying trends in the marketplace, what our objectives are as trend followers. Then we'll talk a little bit about rules and systems, and I think we can check the box here tonight that all of you have a really routine practice. You're showing up after a long day in the markets to learn something. Now if you keep doing that, those small habits over time yield incredible results. So congratulations to all of yourselves for being here at this event and taking time away from your families to come listen to us tonight. And then the third piece, we're going to talk about portfolio construction in real time, or how you might isolate areas of the market where we want to be mining for opportunities and finding those trade ideas. Sound good? 3 things. You guys are with me, only 3. All right, what are the tenets of trend following? This gentleman here, John Henry, might be a familiar name to you if you've ever read the book or seen the movie Moneyball. Anybody read that book? Okay. So I know this is cricket culture, but I want to talk about baseball for just a second. John Henry grew up in a very humble beginnings. He was on a soybean farm in southern Illinois, middle of nowhere in the United States, middle of the country. And he learned the commodities trade. On the soybean farm, they had hedge positions. And what he learned by trading commodities was that if you could separate some of his thoughts or beliefs or opinions about the market and instead be more mechanical and quantitative, that he had a big advantage over other investors. And that's a lot of what we're going to talk about today, separating those emotions or what we think we know about markets from what's actually happening. Now, John Henry took that same idea of separating your behavior or your opinions and simply looking at what's actually happening. He did that with the Boston Red Sox. They're a championship-winning team because he changed the way they selected players. He said, let's just look at the statistics of the players and stop worrying about the legacy of this family or these more qualitative or subjective views that player selection managers have. Now, he went on to manage the endowment at Boston University. He also bought Roush Fenway Racing. The man is a very successful billionaire investor in the United States, and all he does is look at charts. He's a trend follower, he's a technician. So let's dive into what do we mean by trend identification, right? When we pull up a price chart, we start with maybe the simplest thing, which is just eyeball the chart, and if it's moving from the lower left-hand corner to the upper right-hand corner, that's a trend, right? A series of higher highs and higher lows. We want to own those, and we want to short the ones that have a series of lower highs and lower lows, right? Well, it's very subjective, and it only works at the end of the trade, not at the beginning of the trade. So we have to think about something more mathematical to identify those trends earlier on. So we come to a tool like Donchian channels. Has anybody ever read about the turtle traders? Yeah? So Richard Dennis in Chicago in the 1980s made a bet with his business partner, and he said, I can teach anybody how to trade. He traveled around the world, and he saw these turtle farms in Singapore, and he said, I bet we could grow traders the same way they're growing these pets. The original turtle traders included people like Jerry Parker, who's now a dear friend of mine and of the CMT Association. He runs Chesapeake Capital, and he's still, to this day, employing much of the same system that they learned from Richard Dennis in terms of following trends. They use Donchian channels to time most of their entries. And all we're doing is we're tracking, you know what, it's going to be hard for you guys to see. I have very dark looking charts, but we're tracking new highs and new lows in Donchian channels. Very, very simple concept, but it takes that subjective eyeballing the chart and turns it into something a little more mathematical. Well, we love Donchian channels, but does anybody use a moving average on their charts? I should probably see all hands going up right now. Moving averages, right? Who doesn't use a moving average? Okay. So here's the basic bullish idea that price relative to its historical average, right? If it's above the moving average, that's a bullish thing. If it's breaking below, that's a bearish move. Well, if one moving average is good, why don't we get 3 on the chart? And then we can look at moving average crosses, right? So now we've got some Donchian channels, we've got multiple moving averages, and we can spot these areas where the shorter period moving averages are moving above the larger period. Well, I'm cruising through these things because I think this is all very familiar territory. If we've got moving averages and Donchian channels, why don't we look at Bollinger Bands? John Bollinger, one of the very first CFA, CMT dual charter holders in the world, also a dear friend and frequent speaker at our CMT conferences. John Bollinger came to this idea about volatility compression leading to volatility expansion. So if we want to identify a trend, we need to look at price moving against the upper or lower bound of a Bollinger Band. Bollinger Bands are very simple. It's 2 standard deviations away from a mean. And we know in a normally distributed data set, math tells us that 2 standard deviations should encompass over 85% of the data. Well, markets aren't perfectly normally distributed, but that's another lecture. So we know that price moves to the upper or lower band are very significant. We have to pay attention to those. So we can identify trend breakouts from Bollinger Bands. Well, all of this is very, very helpful, but what about the enthusiasm or the participation of the market in these new trends? We have to look at volume, right? So we add volume to our chart. We're looking for areas where volume is expanding in those upward moves. But we don't stop there. We could add things like the MACD, Moving Average Convergence Divergence indicator from Gerald Appel, who won the CMT Association's annual award just a few years ago. We want to add a momentum component to what we're looking at on the chart. Now, all of this is to say we have a checklist. We have multiple things that we're looking for to confirm that we're in a trend. That's really responsible, right? We want to make sure that we're not looking at any one indicator in isolation. We're looking at a composite blend of information from the marketplace. Well, here's the problem. I don't know if you guys can see that little blue circle. Somewhere in these 2 months or 6 weeks, we could identify that there was a new trend beginning. But where in those 6 weeks would you have placed the trade? It's very subjective, right? Did it check all the boxes of all of the elements on our checklist? Well, I don't know. I just lost a bunch of money in this security. I don't know if I want to get back in quite yet. I'm going to wait for full confirmation from everything. Or maybe you're ultra bullish and you're getting in too early before your checklist has really been crossed off. The point that I'm trying to make is that all of these technical indicators, these powerful tools, I mean, what a lucky group of people we are to be investing in a day when we have this cornucopia, this arsenal of amazing tools. The problem is, and I went through this problem myself, after going through the CMT program, every chapter had new ideas and more things for me to throw on my chart. Well, what you end up with is analysis paralysis. You end up with too many indicators on your chart that makes a trade decision very, very difficult. Now, consider your clients, right? You're all professionals and have been doing this for a long time, and you have your approach. But your clients might be new entrants to the market. And when they start to look at a squiggly line chart like this, they're totally lost, right? It's a bowl of spaghetti or a mashed up curry. So what we did with GoNoGo charts was take the same concept, multiple indicators, a checklist approach, the weight of the evidence to tell us when we were in trends to the upside, to the downside, or neutral. And so very, very simply, it's built-in risk management, meaning, I don't know if you guys can see everything that's on those screens, it's a little bright, but what we've done is taken that composite view where our trend model is reflecting a bullish trend, and we paint those bars to represent the weight of the evidence. And we took all the indicators off the chart, because the most important indicator we have of all is price action itself. And I loved reading Edwards and McGee. Everybody read the Bible of technical analysis? Classical pattern recognition, support and resistance areas. You can't do that if you have a overcomplicated chart. But you want all of those indicators to give you the weight of the evidence from a trend perspective. So just running down the list, we have a strong bullish uptrend, that's blue. We have a weaker form, right? We built some sensitivity into the model, so we know we're still in trend, but in the weaker form when we have these aqua bars. Amber bars, we call those the, you've got go conditions. If you're thinking about a shuttle launch, go or no go, pass, fail. But we also have go fish bars, because we're big fans of the life and work of Jesse Livermore, who's famously quoted as saying, in all markets, there's a time to go long, and a time to go short, and a time to just go fishing. Because the market doesn't always give you a decisive trending market. Sometimes we're range bound, and that can be really dangerous for trend followers. So amber neutral bars indicate that neutrality. All right, there's another concept I want to talk about, which is multiple time frame analysis. There's a great book on this subject written by Brian Shannon. He's a CMT charter holder and another close friend. I was actually with him in Las Vegas at a conference a couple weeks ago. It was a broker-dealer conference with about 300 people, well, 300 people at the evening events with all the drinks, and then maybe about 120 at the actual sessions during the day. They're a little less responsible over there in the US. But Brian has a great book on multiple time frame analysis, and it starts with our dear friend Charles H. Dow, 130 years ago. So no computer power, just observing the ticker tape. And this man was really prescient. He was before his time. He understood that markets moved in multiple periods. Now, he's an accomplished nautical sailor, and he used this analogy of the oceans to explain market dynamics. He said this primary trend, it's unflappable. It's not about investor opinion or behavior in the markets. This is the expanding GDP, gross domestic product. This is the underlying fundamentals of the companies we're investing in from an equity perspective. He said that primary trend is like the tides in the ocean, right? So we want to make sure that we understand what that long time period is telling us, because the secondary period is like the waves on the surface of the ocean. Now, as the tide's coming in and you have waves rolling over, you get a really high tide, right? So the secondary period can move above and below that primary trend. And then he talked about the minor period being like the ripples on the surface of the water. And that's that short period, almost completely driven by investor sentiment, its behavior. The fundamentals haven't changed, the macroeconomic landscape hasn't changed, but we as technicians can profit on all three of these time frames. So whatever time period you trade in, this little section is about making sure that you're looking at multiple time frame analysis to understand where that primary trend is headed. And are you trading with or against it? Either is fine, right? You can be a mean reversion trader. You can be looking for the arbitrage there. But you have to know that you are trading against what the overall market drift has been. All right, let's move on. So let's talk about multiple time periods and use some GoNoGo charts. This is a chart of Apple. Anybody ever heard of the Apple company? Yeah, okay. Mega cap stock of the day. And these are monthly bars. So we're talking about more than a decade worth of behavior. Well, I'm eyeballing a pretty nice trend from lower left to upper right, right? Now that's not investor sentiment, that's strong fundamentals. That's 15 years of new iPhone releases, right? That's the fundamental story of Apple. And when I went through my MBA program, it was all about understanding valuation metrics, understanding return on equity or margin expansion, understanding those growth components from a fundamental perspective in a corporate finance background. And then I got to New York and I found out, oh, that's how companies work. That's not how the markets work. There's a whole other toolkit for how markets work. So we can use these very long-term charts to understand not only important primary trend elements, but we can also isolate these areas of key support and resistance. Everybody know what I'm talking about when I say the word polarity? Right? So you've got these areas of the market where, areas in Apple, where we came up, we made this high, and what did we do? We came down to test this former high, right? And then we came back up and broke through. So this was resistance. Once we break through resistance, it becomes support. Now on this very long-term chart, again, this is like a career-ending move in the Great Financial Crisis, but this area that was resistance now becomes an area of support 5 years later. Pretty fascinating. And we can do that across the time frame. You can see what's happening on that longer-term perspective to find those areas of capitulation. So let's zoom in from that monthly view. Let's look at weekly charts. From our trend model, right? I guess that was the other point to make on this long-term chart, is that Apple never broke our trend conditions. Not once in this entire decade-long period. It's still been in trend. Now, would I recommend to any investor that you just buy and hold something? I mean, this is a 30% drawdown right there. No, I would not suggest that you take that kind of risk, but it's helpful to understand that broad perspective of where we're coming from. All right, let's move on to the weekly time frame. Now here we saw the pandemic collapse. We had a bar of neutrality and then back into trend. And here, in 2022, we actually broke out of the go trend into no-go territory and some neutral bars. But basically, we got the signal on this weekly time frame that it was time to get out. And what's fascinating about, this is anecdotal, right? But when we look at our trend conditions changing, they tend to change at major inflection points, breaks of major trend lines. It's fascinating to me because we didn't program any of that into the algo. But it lines up with key breaks of key trend lines almost every time. Breaking out through this downward sloping trend line, we entered a new go trend. Fascinating how that works, right? Many technical indicators computed in the back end, and then this very simple price action analysis, drawing some trend lines, right? I love Edwards and Mickey. These guys in the 30s have figured out way more than we can with the computing power of today. It's amazing. And even this pullback right here, back to our former area of resistance, we found support and took off again. Pretty fascinating how that works. All right, so let's keep going. This is a weekly chart. What's it look like on the daily? Well, that little pullback that we were talking about, still in trend on the weekly chart, that's some pretty sharp no-go territory on this daily basis. You all see how it goes to that as no-go conditions? It's on a pullback on a weekly basis, right? Still in trend. But for us trading rules, if we're trading a daily time frame, we're out of Apple at that point. All right, how about an hourly chart? We're in weak go conditions. And we can isolate these areas where there are important gaps, right? We know how important gaps are for areas of support and resistance. How about on a 1 minute chart? Anybody trading this fast? Intraday? Yeah? Minute charts. God bless you. I have to take lots of antacids if I'm trading that short of a time frame. That freaks me out. But here we see Apple on a 1 minute chart. The conditions are the same, the calculations are the same, it's just a different time frame. And we know that on this short intraday period, we're in a strong no-go trade. right? We're shorting Apple if we're on the 1 minute chart. My point about these multiple time frames is that you can absolutely short Apple. It has periods of resistance. But just know that you're shorting in a primary trend that's moving higher. Okay? Everybody still with me? All right. Let's move on to the second section of today. What are the rules? How do we think about trading decisions at GoNoGo charts? I talked about that checklist approach. I talked about our habits. You're all here listening to me talk. You're taking notes. That's a great habit, to be a lifelong learner, to continue to pick up new books, expand your mind, read more. So our first rule is with this trend model. We want to be owning things that are in go conditions, and we want to be out of or shorting things that are in no-go conditions. Pretty simple rule. It's calculated on a weight of the evidence approach, but that's not really where we end. If you were just to use this in its most simple context, and maybe this is familiar to many of you, if you have trading rules, when a security breaks your trend rules, you get out, right? You cut your losses. It broke, so now I'm out. Well, a lot of retail investors don't do that. We're going to talk a little bit about behavior in just a second. We talked about the complexity of using lots of different indicators on your chart. Every one of these indicators is very valid. It's exactly what we should be looking for. But I don't know where on this chart we would all agree on a sell point or a buy point. How do we know when the new trend has begun? So if we're just going to use MACD crossovers, the other problem with this is that we would be in and out and 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 whipsawed around and trading, over trading our positions based on signals that are too frequent. Anybody ever had that problem? The frequency of signals, right? Wouldn't it be nice to just buy something, hold it through the length of the trend, get out when that trend ends, and then get back in when the new trend begins? So as a trend follower, I got here to India by flying on a plane. Do I know the first thing about Boolean dynamics or whatever it's called that gives the airplane lift? No. I'm not an expert on the fundamentals of flying a plane, but I have my rules. What are my rules? Well, I show up when it's time for me to board my flight. I don't try to get there a week early. I don't show up an hour late to the flight and run out onto the tarmac to try to jump into the trade after it's already taken off. I certainly don't disboard the plane mid-flight, right? I don't end before the trend is over. I wait for it to touch down here at Delhi International Airport, right? These are my rules for flying on planes. We should have the same kind of rules for following trends in the market. All right, let's talk about how this doesn't work. This is the audience participation section. So everybody get ready to answer some questions for me. Research conducted by Terence Odeon. He's a Haas Berkeley School of Business professor and an expert in behavioral finance. Did a lot of deep research, he and his team, of over 360,000 traders over a 15-year period. I think in the maths class they call that statistically significant data set. They looked at a lot of numbers, all in aggregate, 360,000 traders over 15 years. And my question to you right now is, what percentage of those folks lost money over that long time frame, over those 15 years? Definitely E, 87%. Anybody over here? 87. Oh, have you guys seen this presentation before? I'm worried, I'm spooked now, because maybe you guys are way more advanced than I am.
In India, it's 95%.
95 in India, 87 in this study. This is a few years ago. This was published in 2011. I think there is a new dynamic since 2020, where the economy shut down, the government handed out some stimulus, everybody opened a trading account, everybody became a stock jockey overnight, and they did that at a time when the markets were just going up. That feels good, right? I'm a genius. I invested some money and I made some money back. Well, everybody's a genius in a bull market, and over 15 years, you're likely to have multiple market regimes. So these folks, even if they got in a great bull market in 2021, they suffered some serious losses when we got through to 2022. That's probably why it's at 95%.
Have we compared this with the market average as well?
With professionals?
Yes.
I'm going to talk about them in just a second. So only 1 in 360 was actually consistently profitable over that long period. And that's the part I want to talk about. not to just bum everybody out, but how do we become more consistently profitable? So here's the follow-up question. Same group of researchers, they went to DailyFX, or a retail currency broker, and 15 different currency pairs. They looked at 43 million trades. Again, statistically significant. Now here the question is, what percentage of those trades were profitable trades? What percentage had the directional bet correct? 70%? Out of these? I'm hearing some 50%, I'm hearing some
27%.
27 COD. I love this. I wish I was a game show host. I feel like I missed my calling. And I wish I played The Price is Right here, right? This is fun. The answer is over 50% of the trades were profitable. But we just said that nobody makes money in the markets. And yet, more than half their trades are profitable. What are they doing wrong? The win-loss ratio is higher than 50%. Why are so many traders losing money? It comes down to position sizing and their profit ratio per trade. They are holding on to losers and they are cutting short winners. Anybody ever done this? I've done it. Everybody has done it. Exactly. Now, the discipline of money management is what really separates you all from clients or from the average investor in the markets. Because we have to have a disciplined approach and have some rules for when we get in and when we get out of trades. So what we're really looking to do is participate in these trends, not anticipate them. We don't buy something in a downtrend hoping that it reverts and comes back up in our favor. We don't buy downtrends. We want to remove subjectivity. Anybody ever turn on financial news media? Anybody ever listen to the yeah. It's a constant stream of negativity. You would miss out on all bull markets if you just listened to the news media, right? Markets have a very different story from what's coming out on our televisions and radios. We want to remove our own opinions because the market doesn't care what I think or what I hope. Hope is not a trading strategy. And we want to remain objective to stick with those rules. So here's, to get a little mathematical, the expectancy formula, right? There's only 4 outcomes every time we place a trade. We can have a small loss, no problem. We can have a small win, that's great. We can have a really large win, that's fantastic, that's what we're all after. Or we can have a really large loss. And it's that 4th option that we have to control. We cannot have that risk of ruin. And we can't have our clients churning through their accounts, right? Losing our brokerage account holders because they take these huge bets and they don't have risk management in place. So this expectancy formula, what we're seeing on screen, is where this efficient frontier is. So this line right here is where a trading strategy breaks even. And it's that combination between the percentage of winning trades and the profitability of those trades. So this is our edge, understanding what companies we want to buy, what securities we want to hold, which commodities are trending. And this is how we manage the trade. Do we let our profits run? Do we cut our losers short, as David Ricardo told us 400 years ago? I mean, this is not new wisdom. Guys, I'm not inventing anything new for you tonight. This is old school stuff. Now let's just pick on one dot, just for fun. How about this blue dot right here? That's a 50-50 win-loss ratio. That means you can look at the Nifty, or you can look at 3,800 listed securities and just flip a coin. Should I buy it or not buy it? Let's just say that was your whole investment strategy, flipping a coin. Okay? You could still be profitable so long as you had the trading discipline to cut losses short and to let winners run. And actually, Jerry Parker does this exercise with his own funds, Chesapeake. They model out their strategy based on totally randomly selected portfolios, highly diversified, right? They might hold thousands of securities in a systematic fund, but they're testing out the robustness of their trading strategy by saying, let's have no opinion about the market. Let's buy everything, or let's just randomly select securities and see how this plays out. Now, somebody like Jerry is really comfortable right over here. He's fine to be right 30% of the time. Most of us are not that comfortable with being wrong. I'm going to go back to baseball for just a second. When we have a player who's, I'll use a cricket analogy, hitting sixers nonstop, that player has a great batting average of 300 over the course of their career. What happens to them? Children are carrying around their playing card, they're wearing their jersey, they're celebrated, and they get into our Hall of Fame. Well, if you have a 300 batting average in Major League Baseball, that means you strike out 70% of the time. These guys are the best. They are the greatest athletes in the sport, and they are wrong 70%